Goldman Sachs, JP Morgan, Morgan Stanley. These names sound powerful, but what if I told you one banker once saved the entire US economy, another secretly financed wars in Europe, and one legendary firm collapsed in a single weekend? That's the real story of investment banking. In this video, we're breaking down what investment banking actually is, how it started, and why its history is filled with wild stories, from railroads and junk bonds to Tesla and trillion-dollar megabanks. And stick around, because later I'll reveal the single deal that made Goldman Sachs the king of Wall Street. In most industries, history is a nice to have. In investment banking, it is the business. If you're a government raising billions, do you trust a startup bank or one that survived wars, crashes, and revolutions? That's why legacy names like JP Morgan and Barclays dominate, even after a century. And if you think history doesn't matter, wait until we get to Lehman Brothers. Back in the 1800s, the US was exploding with railroads, mines, and factories. Local banks couldn't keep up. Enter the investment banker. Instead of lending deposits, they raised huge amounts of money by selling bonds and stocks to investors. Kuhn, Loeb & Co. basically bankrolled America's railroads. In Europe, Baring Brothers financed global trade, until one massive bet almost wiped them out. But more on that later. Here's a scene straight out of a movie. In 1907, the US banking system was collapsing. No Federal Reserve, no safety net. Who saved the day? JP Morgan himself. He locked rival bankers in his library until they agreed to pool their money and stop the crash. That one move stabilized the entire system and directly led to the creation of the Fed. But it also raised a terrifying question. Should one man have that much power? At their core, investment banks are like middlemen. Governments need money, so they issue bonds. Companies need capital, so they sell stock in an IPO or a secondary offering or offer corporate bonds. Investors want returns. The banker in the middle makes sure the deal actually happens. But when it goes wrong, Baring Brothers found out the hard way when a single rogue trader in Singapore nearly sank them in the 1990s. Proof that even the most established centuries-old names aren't bulletproof. So why can't your local bank just do all of this? Because commercial banks take deposits and make loans, while investment banks underwrite securities and advise on giant deals. Think of it like this. Commercial banks are more like mechanics, investment banks design and sell the cars. Eventually, banks tried to do both. And let's just say that scared regulators just a little bit. So in 1933, the Glass-Steagall Act forced commercial and investment banks apart. For decades, the two worlds stayed separate. But in 1999, it was repealed. Suddenly, megabanks like JP Morgan Chase and Citigroup were born. And that repeal? It set the stage for the 2008 financial crisis. Fast forward to the 1980s, Wall Street was on fire. Michael Milken and Drexel Burnham Lambert turned junk bonds into weapons for corporate takeovers. Entire industries were reshaped. And the pay? Astronomical. By 2006, the average Goldman Sachs employee earned over $600,000. But in 2008, it all came crashing down. Lehman Brothers collapsed in days. Merrill Lynch was sold off. Goldman and Morgan Stanley had to reinvent themselves to survive. It was the ultimate reminder: trust takes centuries to build, but only a weekend to destroy. Today, investment banks focus primarily on four things. Number one, capital raising, like Tesla's multi-billion-dollar stock offering. Number two, M&A advisory. Think Disney buying Marvel. 3, sales and trading, executing trades for clients and themselves. And 4, asset management, running money for pensions, governments, and hedge funds. Now, conflicts of interest still exist: trading versus advising, research versus underwriting, which is why regulators force firms to build ethical walls. Now, do they work? Let's just say sometimes. Remember earlier I teased the deal that made Goldman Sachs the king of Wall Street? In 1956, Henry Ford II gave Goldman the mandate for Ford's IPO, the largest in history at that time. That single deal cemented Goldman as the name on Wall Street. So here's the takeaway. Investment banks were born because traditional banks couldn't keep up. Powerhouses like JP Morgan literally saved economies. Laws like Glass-Steagall shaped Wall Street for decades. Crises like 2008 proved no bank is untouchable. And today, investment banks still control the flow of global capital. Now that you know the real story of investment banking, hit the next video right here where we stack it up against other finance careers and see which one really pays off. Stay strong.